Gautam Chhaochharia also with us this morning, as well as Sandip Sabharwal, who's right here with us in the studio. Gentlemen, good morning and thanks for joining us. Gautam, let me come across to you first then. We're tracking, of course, the fact that markets are still reeling, not just from the budget, but also the global scare, waiting to see if that hangover continues into today. Now that we've got some of these major events out of the way, what's your sense going forward? Do you feel that, markets are going to fall even further from here? What's your sense?
Short term is always tricky to forecast, but yes, clearly the global overhang is not supportive of Indian markets in the short term. Markets had elevated expectations from the budget, especially equity markets. And in that context, there was some disappointment clearly because measures to stimulate growth, etc., in the short term clearly did meet markets' expectations. So there is some disappointment from there. But obviously, beyond a day or two, the focus will shift back on the other macro data prints as well as earnings locally and what's happening globally to drive market trajectory here on.
I want to establish what's happening in China, and this is something which will have far-reaching consequences. I'm surprised it took so many days for world to realize where China is set to open when it opens after that Chinese New Year break. The Chinese central bankers have really talked about pumping in about $170 billion. Chinese, because of China, all the metal prices have completely collapsed. And even though Chinese government has come out with curbs on how short selling and other things would be done, China's down by about 8.5%. So that just tells you how the world, how Chinese and how world is actually reacting to the coronavirus. Sandip, the bulls would say, look, Saturday was a half day. Banks were not operating, institutional investors were not there, margin funding came in. So the selling was overdone and markets will come back on Monday. Do you buy that argument?
No, the inverse can also be true, that a lot of people were not there to sell on Saturday, so we don't really know. But like Kunal was saying that markets have fallen nearly 800 points from the top, so there could be some short-term bounce back here and there as markets get technically oversold. But I would think that next 2-3 weeks should still be concerning from the global perspective, because the outflow from global funds into equities had reached euphoric proportions, inflows had reached euphoric proportions, and we've just seen the first leg of the outflow. Now, typically, we've seen that ETF flows tend to be trend following. So when the trend gets set on one direction, then the flows keep on increasing or decreasing rapidly. So I think that could happen, and with little domestic support for equities, I think if we get a substantial global outflow, then markets should correct a bit more. So in that context, I would think that market could still fall 3-4% more over the next few days. But then after that, it has to be in the perspective of the economic outlook, which has bottomed out, but then at the bottom it's just lingering around, so we are not really seeing a uptick in the domestic economy. So how that plays out will decide the pace of the recovery after that.
Gautam, just when we thought that mid and small cap stocks had bottomed out, you've got this coronavirus issue. Given that nothing big has come from the budget, where do you think markets would move from here, given that there is lack of any trigger? RBI has done its bit, inflation has made a comeback. So what will be the out of jail card for us now?
So again, the near term is always tricky to predict, and always obviously what the framework you described does make the next month or two still tricky. But in our framework, just to highlight, from the next 1 to 3 year perspective, we do see the building blocks of the next broad-based earnings cycle in India, and I'm specifying earnings cycle, not necessarily GDP print, which is a big change coming after our bearish view on India's earnings growth for the last 5 years top down. So those building blocks have not been impacted by what we saw in the budget, and obviously coronavirus etc. does play a role, but again that's near term. Hopefully that's behind us soon. Gautam,
from an institutional investor standpoint, I what's happened to China because of coronavirus is unfortunate. But for someone who's saying that, look, I'm an allocator and I need to look at news and economy and growth, because it's sad to see what's happening in China, but for an asset allocator, if somebody has to make a choice between China recovery or India recovery, India will have a better chance of recovering now. Do you think money moving out of China, moving into India, allocations getting increased towards India?
In the very near term, possibly, but not necessarily in the medium term. Asset allocators looking at big pools of money don't necessarily react to short-term events like this. But yes, tactical fund managers or hedge funds could react and make those calls in the short term. So yes, some short term those kind of trade and activity is possible. But unless we see this coronavirus thing being prolonged, it won't be necessarily meaningful material medium term reallocation of flows. But yeah, in the short term, that thesis could work.
The selling in metals, Sandip, there's no scientific way to establish what will be the slowdown in China. You will have to look at the data which comes from there. And we all know that that's not the most authentic data which will come from China. The fact that the Chinese government today has reacted and acted, they're looking at infusing about $200 billion. From an economic standpoint, whenever the virus peaks out, today, tomorrow, this week, next week, do you think the turn of events in terms of global market, Chinese market, metal prices could be equally sharp?
Could be, but the liquidity response in such a scenario normally it doesn't help the economy at all, because the economic impact is due to events which are unrelated to monetary policy. So to that extent, monetary policy having a positive impact could be there in the stock markets or the bond markets, but not on the real economy. The challenge for the Chinese now is that they, as it is, had a slowing economy. Most of the tariffs which the US has put are already still on, and on top of that you get this hit which is going to impact domestic demand. So at a time when debt levels also are elevated in that economy, such a hit could, so although the impact could be short term, maybe this virus gets controlled by the time spring, summer comes, so viruses are more prone to spreading during winters. So as we get to more warmer weathers, most probably this entire virus issue will go away. But then the lingering impact of this on the economy, like I said, how the way demonetization hit our economy for a prolonged time, although it happened in a small phase of time, something similar could happen to the Chinese
I must
economy.
confess that I'm using that thought of yours, quoting you, of course, that like Sandip said, that what happened to demonetization in terms of getting the track down, I think that's going to happen to China. Very unfortunate. See, guys, what's happening to the virus, you have to look beyond economy sometimes, but when you only have to look at economy, considering that there's a health hazard and it's going to have impact, I think it's unfortunate, but yeah, China's going to slow down.
It's a very serious issue that we're facing right now, and we're continuing to see it, take over all the headlines day on day. But Sandip, Gautam, do stay with us. We're going to...
Well, I'm in conversation with our technical experts, Sandip Sabharwal and Gautam Chhaochharia. Gautam, so, when your clients will call you today, Gautam, what should we worry about? Coronavirus, valuations, budget becoming a no event. What should be the focus and what is the right time to buy and participate? How would you answer this simple query?
So very simple, and depends on the investor. If investor is looking at a 1 to 2 months view, then obviously there could be tactical downside in the short term. But any medium-term investors, any correction around these themes, in our view, would be buying opportunities into India, given our framework, which suggests recovery in the broader earning cycle after being bearish last 5 years. So depend on the investor, but any investor looking beyond next 6 months, we would advise to buy in dips.
There's a flash on, this flash will just come up on your screen once again. While I'll wait to read the flash, I'm going to just get one more quick comment from Sandip. Sandip, the selling in insurance stocks rather, yes, overdone. Do you think insurance now, if they correct another 5 to 10% here, will structurally nothing changes for insurance, right? If insurance stocks correct another 10% from here, will there be a good buy then?
So on insurance, especially the life insurance companies, my view was that they had run much ahead of fundamentals. I think there was sort of panic buying in insurance stocks because in the absence of people finding opportunities in banking and avoiding banking stocks in general, people were flocking more to insurance stocks. Now we've taken a hit because, and this is a fundamental factor which has impacted and which could have a long-term impact on valuations. So I would think that we need to wait more. We need to wait for this entire over-allocation to insurance to somewhat ebb, which could take some more time. So if the markets themselves fall another 4-5%, then insurance stocks could take a much bigger beating. So I would think that we should wait it out rather than try to jump in immediately on a sector where many of the stocks have gone up 70-80% just in the last 1 year.
But Sandip, just to play devil's advocate here, income tax benefit or not, everyone needs insurance regardless, right? You're not going to cancel your life insurance policy just because you don't get the tax benefit.
Yeah, but unfortunately, the way it's been sold in India to many of the people, so let's say there are 5% of the people who look at value in insurance and buy it. There are another 95% who just buy it because it's sold as a tax-saving instrument. So if it can no longer be sold as a tax, it can be sold as a tax-saving instrument. There's no compulsion for you to move to the other tax regime. But then the overall growth outlook for at least the next 1 year till the base changes, instead of, let's say hypothetically, the growth projection being 20%, it could come down to 5 to 10%. So if the growth projection comes down to 5 to 10% for the next 1 year, then the valuations in the near term should correct more. Then the base will get set and then again the cycle of growth will start. So I would think that even over the next 1 year, 1 full year, I would think that life insurance stocks could actually underperform.
Okay, we've got that exclusive on your screen. A couple of things. A, the BPCL expression of interest should be out by the end of February. And B, on LIC, it looks like the government may look at listing about 5 to 10%, and that in itself could help them to raise about 80,000 crores on initial estimates. The Financial Services Department has written to the Law Ministry on that listing plan. Remember the Finance Minister talking about how already some of those divestment plans had been in the works the last 6 months, and also now what they are planning with LIC will be on priority. And so even if it's not all happening within March, it will definitely be happening this year. They are definitely looking at seriously. But, also on BPCL, an alternate mechanism that they're possibly looking at to finalize, on those EOIs. Let's in fact go across to Ruchi. She's got in-depth details on both of these. Ruchi, on the divestment agenda then.
Absolutely. Abba, if I should put it like that, we at ET Now had told our viewers that in FY21, the government is all set to give the highest ever disinvestment target to the department. And as they've done that, it seems like the pipeline and the work has already begun. Let me first begin by talking about BPCL. I'm given to understand the expression of interest for BPCL's privatization is very much on. In fact, it will be put out by the end of February, and the alternate mechanism that has the Home Minister Amit Shah along with the Finance Minister Nirmala Sitharaman will be getting together to finalize the expression of interest for BPCL very soon. Remember, just 2 weeks ago, we had seen the government coming out with the expression of interest for Air India. They're going to do the same for BPCL so that at least the process kickstarts in this fiscal year itself. Having said that, the massive announcement in the budget that was made was to do with the listing of LIC, something that we at ET Now had told our viewers as well. I'm given to understand the Financial Services Department has already written to the Law Ministry on the listing plan for LIC and have sought their opinion on whether changes are needed in the LIC Act for the listing of the life insurer. I'm given to understand that the government is yet to ascertain the quantum, but anywhere between 5 to 10% is going to be put on the block. And this would mean that LIC would be India's own Aramco, if I should put it like that. It could help the government garner a 10% stake, could help the government garner as much as 80,000 crore rupees. Of course, it's going to be a long plan, but the government seems to have already started the work on it.
Okay, thank you for that, Ruchi. Sandeep, a 5 to 10% stake, 80,000 crores. They've been stepping on it with regards to Air India, with BPCL, but obviously LIC is going to be the big one that markets will be watching out for. Do you think it's achievable? Do you think we're going to see, that kind of interest at higher valuations for LIC? What do you expect?
I don't think we'll see interest at very high valuations. So I think if valuations are reasonable, we'll see interest. But raising a huge amount, like if they want to divest 5 to 10%, try to raise 70, 80,000 crores, that will be tough, because in a PSU company in India, with whether investors will be willing to put that kind of money is a question mark, especially given the fact that there's been complete value destruction across PSUs in India over the last 5 to 10 years. So if you look at the total value of PSU stocks listed versus the total market capitalization, I think it will be at a multi-year low today, because successive disinvestments have happened at lower and lower valuations. And so when we were talking of the life in the insurance companies, I think the LIC issue might also be an overhang on the valuations of the other companies, because such a large issuance will come, so people have more opportunities. And for the government to come out with such a large issuance, the valuations will have to be very attractive. So relatively, if the largest company comes at a valuation which is much cheaper than the other listed peer, then those companies' stocks will also correct.
Gautam, let's get your view in on this as well before we let you go today, because clearly this is going to be the next big thing that markets will be watching out for.
Absolutely. So, and beyond, it's very speculative to have a view on valuation and how much they can raise, etc. But beyond valuations, I think both LIC one and other privatization being mentioned is also a very material reform statement if they're able to execute that, which will have implications for broader market multiples. So the numbers are aggressive in terms of totality, but it's also a bigger privatization agenda compared to the piecemeal disinvestment which the government has been doing for the last few years, and then in itself has a very strong signal for the market.
Gautam, good to have you on the show. We'll let you go on that note.
Bajaj Finance and the DMarts and the Page Industries of the world, they've got nothing to do with Corona. They are growing, and if at all, if there is bad news for others, they're gaining more market share.
Yeah, so that's right. So now some companies might have their own valuation issues, but I think given the growth paradigm in which something like Bajaj Finance is, and given the fact that they seem to have sidestepped the entire NPA quagmire, even at a time when HDFC Bank seems to have taken some hit, speaks very well for whatever they are doing. So I think that's one stock where if there's a market sell-off, some big outflows, it could also correct, and that will be an opportunity. Similarly, I think something like Page Industries, etc. I think all these companies are very good to buy on any sell-offs which are induced due to events which have nothing to do with those companies. So I think that's how investors should take it. So if the market sell off big time, no stock can escape, but then it's not stock specific. So that gives you the opportunity to buy.
If the markets were to decline even further, Sandip, would you be looking at using this opportunity to buy into any of the names?
Yeah, so on the mid-cap side, there are several companies which will ultimately come back. So on the durable side, they have given some protection. So for small ticket items, so direct beneficiaries would be companies like Havells, Crompton Consumer, or Volta. So a lot of these companies will benefit because of that. Although I don't think that increasing import duty so much is a good idea for the economy's efficiency, but they have done it. So some companies on a micro side benefit. So I think these will be the companies to look at as the markets correct.
So on HUL and ITC, on one hand, we've got some buy calls coming in on the back of potential recovery on the rural side on names like an HUL. On ITC, the excise on cigarettes once again playing havoc. So we saw quite a sharp fall on that one. So within the FMCG space, what would be on your radar?
I think companies which are more focused rurally, they will see the first benefit. So that's why we've seen Dabur's held on pretty well. But if it corrects due to the overall market correction, I think that will be a good stock to look at. Even Godrej consumer results were not so good, not so, I would say bad, but then the stock's actually given up a lot of gains. So I think in terms of valuation paradigm, that's also an interesting stock to look at.
Okay. On auto as well, because we're watching out for sales numbers now. And while we've had some of the companies allude to, very, very meager signs of green shoots. Do you feel it's still very early days, or would you be looking into auto at this point of time, with an eye to some recovery coming in?
I think comments of most companies on green shoots are more hope rather than them actually seeing that. So, and that's the problem, because if you look at statements of most of the companies, they say we see a recovery 6 months down the line. So 6 months back also they said the same thing. But this time, I think 6 months down the line, we could actually be looking at a recovery, because the base of last year itself will be so low that given a significant monetary impulse plus the rural economy positivity, and although the budget overall is unexciting, but they are projecting a 13% increase in expenditure next year. So a 13% increase in expenditure, which is higher than the growth of the nominal GDP. If the government expenditure increases more than nominal GDP, then typically it should give a fiscal stimulus to the economy, irrespective of the way it's spent. For the bonds movement today, I think the bond markets will watch very, very carefully how the entire fiscal math moves next year.
The only thing which I can pluck out as what could be called as a directional sense, and that's that China is going to be injecting capital. China slows down, global growth ain't going to come back. That surely will have impact on global growth, which means that just when we thought that the inflation uptick was coming back into the economy and bond yields will start hardening, that template, which was a popular template last year beginning in 2019, that template reverses, which means we are in for low growth for more, slow growth for more. And if that is here to stay, we are looking at interest rates remaining down.